What's going on, guys? Welcome back to another video. So in this one, we're going to do a little bit of a good old-fashioned AMC update. There's a couple of things that we need to talk about very specifically with AMC on what we're seeing on the technicals right now heading into earnings. I know a lot of you guys are feeling really awesome about the run that we have just went on. Not so good about the drawdown that we've seen after kind of peaking, but we're going to kind of go over exactly what we're looking at before we head into the week of earnings. Now, in addition to this, we're going to be going over a little bit of what's been going on with the broad market and the actual leverage that is out there in the broad market. There are a couple of things that we've been talking about for a significant amount of time, and we still have to go back to some of these data points to really give us an understanding of just how much these big players are feeling the effects of the massive volatile moves in the market. So again, before we get into all of that information, if you guys do enjoy or find value in this video, make sure you guys drop a like down below. Subscribe if you do want more videos like this, and comment as well if you guys do like this new setup. So when we come over here, we do have to take a little quick peek at the Ortex data. So the first thing that we're looking at here, let me just give this a quick refresh, is currently AMC sitting at an estimate of about 19.6% estimated short interest. Now, the exchange reported short interest data came out yesterday at about 18.65% of the free float. Now, in addition, we also have 143 million shares on loan. So that's kind of where the short interest data is sitting on this right now. But let's get into the technicals on AMC, because if you guys have heard in my live streams, things are looking pretty teetery right now. It's kind of right on the edge of either making a move back up or continuing a pretty significant potential sell-off. Now, coming over here, this is going to be the trading view charts that a lot of you guys already have access to and are able to use on a day-to-day basis. Now, on this 4-hour time frame here, what we're seeing is a P signal right here. What this means, the 13 EMA has crossed down below the 48, and you're seeing closing candles down below the 200 EMA. Usually, this means we're in for somewhat of a bearish trend. Now, today, we were up about 3.21% on AMC during the day, after the Fed meeting in the SPY, in the whole market essentially just went on an absolute moon mission in filling that gap. Now, is this going to continue? Well, that's yet to be seen with GDP coming out tomorrow, but there's a couple of key things that we need to look at here on this time frame. Now, there's a couple of different key levels of support and resistance. This first one here, 1424. If you guys do follow me on Twitter, we did talk about this 1420 level, that it could use this as a level of support. Now, it did end up falling down below. It's back above it now. What we really need to see out of AMC on this time frame specifically, in order to say, yes, this can continue higher, is a break above not only the 200 EMA, the 13, the 48, and then you get a cross-up signal on the 4-hour time frame. If you look at the RSI, it's at 39, so pretty oversold here. You have the MACD curling back up here, but shaft trend is still signaling sell. If you look at it on the daily time frame, though, things are looking a little bit different. AMC is hunting a cross down on this daily time frame here. In the next levels of support that we would really be looking at here on the daily are about 1342, and then below that right around 1294. Now, again, guys, if you do want to learn a little bit more about this strategy, and a lot of people have been saying we just offer alerts, that's perfectly fine. People can think that, but we do over 55 private live streams every single month. We have a fully built out trading curriculum. We have one really successful trading algorithm right now, with 2 or 3 more actually coming. We have a giant slate of things coming for you guys. So if you do want to kind of get in early before these new things come out, make sure you guys check out that link down below. Now, I do want to talk about what has been going on with the margin debt right now. Now, if you guys don't know, when you think about margin, it's like these large institutions gaining leverage on their positions. So they say, hey, I have X amount of money. I would like to control X plus 5 amount of assets, or X times 5 amount of assets. What do I have to do in order to do that? They take out a loan, and they are buying assets with that loan. Now, when you start to see the total amount of margin debt that's actually out there start to fluctuate around, that tells you a lot of things about what these institutions are feeling at this current time, whether or not they are going risk on or whether or not they are going risk off. So what we have to look at here is, well, what has the margin debt been showing us over the last couple of months? And you can see here, this chart's a little bit hard to see, So we might look at the inverted chart down here. So right here on the left in red is going to be the actual margin debt in billions, and it's inverted. So as we come down here, margin debt is actually going up. So when we see this chart shoot up here, it actually means that margin debt is really capitulating and coming down a lot. Now, we're also seeing this at right around the same time that the overall market is selling off as well. Now, what does that tell us about institutions in the market right now? One, they are going more risk off. There's a couple of specific reasons for this. We've seen what the Fed has been doing with rate hikes. What that essentially does is it makes money harder to borrow. It's more expensive to borrow money, but what it also does, and we've talked about this a few times, is it increases the discount rates that are applied in discounted cash flow models. Now, with companies that are going to be a lot more sensitive to these discount rates, which are going to be smaller cap stocks, mid cap stocks, and more growth stocks, when these discount rates increase, it actually creates their present value, a compression in their present value. So the value that they currently have actually decreases. So when the Fed increases interest rates, you start to see present values actually go down, meaning stocks start to come back down. Now, large institutional investors know this, so they start to go more risk off. They sell assets. Now, when you're looking at this chart right here, does this necessarily mean that everybody is getting margin called? It doesn't necessarily mean that literally all of this margin debt getting wiped out is margin calls. But what I want you guys to understand is that we've seen a lot of fluctuations in the overall market and a lot of volatility. We've also seen a lot of very significant funds taking huge losses. Melvin's done. We've seen a couple of other funds go down. We've seen people in the crypto space go down as well. And when you take a look at what the S&P did in June, so remember that data that we're looking at there is for June, and you take a look at what the daily time frame has actually done. In June, the overall market went from about 413 all the way down to these lows. Let's see here. So June 8th, we were trading right around 411. And then when we come down to the end of June down here, we're trading right around 373. So a very significant decrease. Well, if you had either a long only portfolio where they're only betting with stocks going up, and these funds weren't actually sufficiently hedged, well then yes, you are going to see a lot of margin calls. You are going to see people go more risk off, selling off of these assets. Now, it's also very possible that this is more of a transitionary period where they're selling off some of these assets in order to go short or reposition their portfolios. But at the end of the day, what this tells us is that institutional money has not really come back into the market to go fully risk on yet. Now, there's a couple of things that can happen over the next couple of quarters to kind of entice this institutional money back into the market. You almost need to see, like I've talked about a few times with Powell, that the projection for rate cuts at the end of 2023 is kind of up in the air. Powell didn't really say anything specific about this today, but he did hint at slowing down rate hikes. So what we could end up seeing is eventually inflation coming back. We start to see GDP growth again. And again, we're going to see most likely a negative GDP print tomorrow. But as these things start to happen over the next couple of quarters or maybe even years, you're going to see that institutional money come back in and this leverage come back in as well, which is going to lead to most stocks coming up over that mid to long-term time horizon. So that is going to wrap up this video for you guys. If you guys did enjoy the information that I provided for you in this video, if you wouldn't mind going down, hitting that like button on this stream, it helps out a whole lot getting these videos out in the algorithms with YouTube. But other than that, guys, I hope you guys are having a great evening. Made some money today with us with 1348. Other than that, people, peace.